Hello friends, welcome again. This is Skadvisory Private Limited. This is episode 8 continuation on the ultimate beginner's guide on option trading. Next we have the short put strategy, which is the mirror image of short call strategy in terms of payoff. The strategy consists selling an X number of at the money put option contracts. In the payoff chart, we can see that inflection point is determined by the strike price of the put option being sold. If price rises above the strike price, profit is limited by the option premium. If price falls below the strike price, the loss is proportional to how much the stock falls below the strike level. The short call, the maximum risk is not infinite but is very large compared to the maximum reward. So the reward risk ratio is very small, which renders this strategy as poor in terms of risk. A short put is a bullish strategy with one of its advantages is that the profit is same no matter how the underlying stock rises above the strike. However, the risk structure is unfavorable to dangerous. Next, we have a strategy called covered call, which consists in buying 100x shares of underlying stock and selling X number of at the money call option contracts. This is exactly same as a short put strategy in terms of payoff, but it's a different way of putting the strategy without any put options. In the payoff chart, we can observe that this strategy is exactly the same as the short put. So the ideal market scenario here is price rising above the strike price. The risk structure is also the same as the short put. So the maximum reward is limited and the maximum risk is limited by very large compared to the maximum reward. Just like a short put strategy, large maximum risk is a small maximum reward renders this strategy as dangerous. The last of the basic strategies we are going to study is called protective put, and it consists in buying 100x shares of the underlying and buying an X number of at the money put option contracts. In terms of payoff, this is exactly the same as the long call strategy, but there is a different way of building these strategies without using call options. Instead, a combination of the underlying stock input option contract is used to create a semi-payoff, but a call option will generate. The ideal market scenario here is bullish. So it is interesting here that the underlying stock price rises as much as possible above the strike price of the option being used in this strategy. In terms of risk, a protective put strategy provides a limited risk and an infinite maximum reward, because there is no limit how much the underlying stock can rise. The more the stock price rises above the strike price, the higher the profit. In the case that the trader is wrong about his directional, buyer's protective put strategy provides a limited risk no matter how much the underlying stock price drops below the strike. So the protective put strategy has a safer risk structure. That's it for this session. In next episode we will discuss the new strategies of long straddle and all. So stay tuned. If this information is helping you, then do like, share and subscribe to our channel and press the bell icon to be notified on every update from SK Advisories. Thank you.